Have you ever wondered if your retirement savings could turn into a ticking time bomb? What if I told you that the very nest egg you've been carefully building could explode in a tax nightmare just when you least expect it? Well, stick around today as we uncover the hidden dangers lurking in your retirement plans. And we're going to learn how to defuse that potential tax time bomb before it's too late. So today we're diving deep into the question, what steps can I take to avoid a tax time bomb in retirement? Well, let's take a quick look back at yesterday's show. Yesterday, we tackled the delicate topic of discussing pension income during the dating process. Yeah, if you missed that one, I'm going to encourage you to go back and listen to it. I gave you some practical tips on how to navigate those tricky financial conversations when you have those new relationships without coming across as what somebody said is being a gold digger or a miser. So trust me, it's a must listen if you're single and have a pension, or if you're dating someone who does. Now let's get to today's hot topic. I received this message from Sophia. Now, Sophia actually mentioned she's from Tulsa, Oklahoma, so a shout out to our Oklahoma listeners. And this is what Sophia wrote. She said, "Dear Ralph, I've been diligently saving for retirement for years. I've been maxing out my 401k, and I'm feeling pretty good about my financial future. But recently, a friend mentioned something about a tax time bomb in retirement, and now I'm worried. I thought I was doing everything right, but am I setting myself up for a big tax hit down the road? What can I do to make sure I'm not blindsided by taxes when I should be enjoying my golden years?" Well, Sophia, that is a wonderful and perfect question. I'm so glad you asked that because that's something most people, and I dare to say many people, overlook. And it can have some significant and serious consequences if you don't address it. So that concern is very valid. And it's a perfect example of why we need to think beyond just saving money. But we need to consider how that money is going to be taxed when we go to retire in the future. So, Sophia, your question reminds me perfectly of Proverbs chapter 21, verse 5. And it says this, "The plans of the diligent lead to profit as surely as haste leads to poverty." That's a tough verse, but it reminds us the importance of careful planning in our life and especially in our financial lives. Just as we plan for our retirement savings, we also need to plan for those tax implications of those savings. So as you said, you don't get blindsided. Well, now let me tell you about my client, Robert. Robert's situation is a perfect illustration of how good intentions can sometimes lead to unexpected challenges in retirement. So picture this. Robert, a client of mine, he's a hardworking small business owner. And Robert was this guy, he always prided himself on being financially responsible. For decades, I'm talking about decades, he maxed out that traditional 401k plan, and he was thinking the whole time he was setting himself up for a comfortable sit back and relax retirement. He'd watch the account balance grow year after year, and every year when he got that year-end statement, he felt more and more secure with each of those statements. Well, fast forward to Robert's retirement age at 65. At that point, Robert had done great. He had amassed over $2 million in his 401k, and he felt on top of the world. He would share this with me every year when he'd come in and get his taxes done. Look how much I've got now. Look how much I've got now. But we never really had that conversation about what was going to happen. So he's enjoying the fruits of his labor. But there was a problem lurking beneath the surface. And it's a problem that would rear its ugly head when Robert turned 72. You see, here's the problem. Robert had forgotten about one crucial detail. And that's those required minimum distributions, or what we call RMDs. So at age 72, now this age is changing. Right now it's 73. It's going to go up to 74. These RMDs make it so that the IRS requires you withdraw a certain percentage from those IRA or 401k accounts each year. And here's the problem. You've got to take those withdrawals whether you need the money or not. And here is the kicker. This is the one that kicks you in the mouth. That money is taxed as ordinary income. So for Robert, my client, this suddenly meant that he had to withdraw about $80,000 in his first year of that RMD. And guess what that did? That added to his Social Security benefits, and he had some small rental income. He had a place at the shore that he rented out. And all of a sudden, Robert found himself catapulted into a much higher tax bracket, and it's higher than he ever anticipated. Now, when he came in and sat down to get his taxes done, the shock on Robert's face and we ran the numbers is something I'm never going to forget. He looked at me and said, "Ralph, I thought I was being smart by deferring all these taxes while I was working. How did I end up paying more in retirement?" He then said to me, Ralph, why did I even bother to save all those years when the government is going to take almost half of my money now that I'm retired? He was devastated. He was so angry and disappointed. And listen, it was a tough moment for me, but it was also an opportunity for transformation. I saw his frustration, but more importantly, I saw his fear of running out of money in retirement with having to pay those taxes. So what do? We sat down and started strategizing ways to mitigate the damage and prevent it from getting worse in future years. The good news for Robert is this is what I do. This is my passion. So here's what we did. First thing we did, we looked to see if we could do Roth conversions. So what we did, since he was only 65, we started systematically converting portions of Robert's traditional IRA to a Roth IRA. We did that in the years before he turned 72. Yes, he had to pay taxes on those conversions, and that was ordinary income, but we did it in a controlled manner. We did it so that we could keep him in those lower tax brackets each year. And the goal of that was we were going to reduce the size of a traditional IRA so that when he hit that 72 or 73, he would take smaller RMDs, which would add to his income. Now, I did a show on this before, and I'll put a link in the show notes. I would encourage you to go look at that. The second thing we did, number 2, we explored what's called qualified charitable distributions. You may have heard me say the word QCDs. So once Robert turned 70 and a half, he started making donations directly from his IRA to those charities he cared about. And here's the best part, those QCDs counted towards his RMD. I know we're throwing a lot of initials out there, but stay with me here. But it didn't increase his taxable income because that money shows as an RMD. He checks the box, he made the RMD. But because the money went right to the charity through that QCD, it didn't affect his income. So that was a win-win. And you might ask, why is that? Because Robert was able to support causes he believed in. He was giving them 100% of the money. He didn't have to worry about tax consequences. And at the same time, it helped him manage his tax liability. It was truly a win-win. What's the third thing we did? We diversified his retirement income sources. And what do we do there? We started focusing on building up some after-tax investments. And Robert was heavy in that 401k, but I knew we needed to give him some flexibility so that, when he got to retirement, he could draw from different things each year. He didn't have to take all that IRA money. And see, a lot of people miss this step. And this is a strategy that you can focus on because most people think about, well, just like Robert, I'm going to put as much as I can, Ralph, into that pre-tax 401k because you're saving that money right now, but you're not thinking about that step that's going to happen down the road when you got to take that money out. And the last thing we did, we got strategic about Social Security. We carefully planned when he should start taking those benefits. And by doing that, we were able to better manage his overall tax situation in retirement. Now listen, the transformation wasn't instant. It took time. But over time, Robert's retirement situation became much more manageable. And the truth is, I could see it as we would meet. He went from feeling blindsided and frustrated to feeling like he was back in control of his financial future. So you might be asking, what can we learn from Robert's story? Well, here's some things that I came up with. These are some action items that you can take to avoid that tax time bomb in your own retirement. Number 1 thing, diversify your retirement savings. Just like we work with Robert, don't put all your eggs in the traditional 401k or IRA basket. Consider those Roth options. The reason you want to look at Roth options is they offer tax-free withdrawals in retirement. The second thing you could do, you've got to plan for your RMDs before they're required. You got to start thinking about those strategies to manage those RMDs when you're in your 60s or in your middle 60s. You can't wait till you're 72 or 73 to all of a sudden say, hey, Ralph, what do I do now? Because truth is, there's not much I can do at that point. And I've dealt with clients that found themselves in that position. They already were at that point where there really wasn't anything we could do except for, like my grandmother used to say, suck it up, buttercup, because you had no other choice. You had to take that money out and there was nothing we could do. Now, there's some little nuanced things. You could still do the QCD, charitable contributions and all that sort of thing, but big picture stuff you can't, which leads me to the next thing. And that's consider those Roth conversions in lower income years. Now, you have to do that before you get to that RMD stage. And this is a very specific area of expertise. But you basically can take those Roth conversions and make them happen in years where your income might be lower. Maybe you've retired and you've only got that Social Security earning and you're going to live off some savings. That's the kind of thing that you could schedule an appointment with me and talk about. So I'll talk about how to do that at the end. Another thing, as we discussed, you could explore those QCDs. And if you're charitably inclined, some people aren't, but they can be a powerful tool for managing your tax liability and at the same time supporting those causes you care about. Because listen, we all have those causes that make an impact to us. And if you can help them and at the same time help yourself, it's really a no-brainer. And last but not least, and I've alluded to this many times already, this is a time to get professional help. Look, retirement tax planning is complex, and there are rules that are always changing. It seems like every day I'm getting a new publication about, well, consider this, the Secure Act this, and all these. It will make your head spin. And I don't expect my clients to know those things. That's what you pay me for. So working with a financial advisor who understands both that retirement planning and that tax strategy can be invaluable. So, and I'm going to talk about that in a minute about how you can get in touch with me. Remember, it's not just about how much you save for retirement. That's great. That's a good thing to do. But it's also about how you save and how you plan to withdraw those savings. And if you can be proactive and strategic, you can set yourself up for retirement that's not only well-funded, but it's also tax efficient. You don't have that tax time bomb, because it really is a time bomb. If you don't plan for it, you're going to find yourself all of a sudden, bam, you're going to come in and meet with someone like me. I'm going to say you owe X number of dollars and you're going to fall out of your chair. Now, I want to remind you that the whole point of the Ask Ralph show is to answer your questions. So just like that question we got today, I want you to keep them coming in. Now, you can submit your questions by going to justaskralph.com. And remember, those questions drive the show. It's what I use to come up with the topics for every day, because I know I'm here to help you navigate your financial journey, and I want to do it from that Christian perspective. Well, speaking of help, you might be saying, Ralph, I am lost. I'm worried that the bomb's going to go off in my retirement. Maybe you're feeling overwhelmed by all this talk of retirement planning and tax strategies. It's all been a big blur to you. Well, I want you to know that you don't have to figure it out on your own. I love working with people just like you. One-on-one, we can create a personalized plan that aligns with your financial goals and your faith. That's what I bring to the table. I'm going to marry both of those worlds together. Now, you can schedule an appointment with me by going to AskRalph.com, clicking on the banner at the top. You'll see what it says. It says, book a call with Ralph. You click it, fill in the blanks, and you'll be set up with me. Now, you might be thinking, Ralph, is this going to cost me an arm and a leg? Well, listen, I believe in being upfront about things. I do charge a $150 consultation fee. That's what I do. I can't work for free. But you got to think of it as an investment in your financial future. Now, during our session, we'll dive deep into your personal finances. Maybe you want to talk about business finances if you're a business owner. But what we're going to do is we're going to work together to create a roadmap for you to achieve all of your financial goals. Now, you might be saying, Ralph, I don't want to give you $150. What if I don't get anything from it? Well, here's the deal. I will personally guarantee if you don't get at least $150 in value from our meeting, I will refund your consultation fee 100%. So why don't you schedule today and let me help you create a plan that will set you up for success. Well, now let's recap a minute just about what we talked about today. Number one, we learned about the potential tax time bomb that can be lurking in traditional retirement accounts. We talked about my client Robert's story and how he was caught off guard by those required minimum distributions. The third thing we did, we discussed strategies to mitigate this risk. We figured out ways to defuse that time bomb. Those things included Roth Conversion, qualified charitable distributions, those QCDs, and also we talked about how to diversify your retirement income sources. And finally, we outlined some steps you can take to avoid a similar situation if you're in your own retirement, if you find yourself in that same place. Remember this, being a good steward of your finances, like I said, isn't just about saving money. It's about being wise in how you save and how you plan for the future. Remember what Proverbs 21:5 reminds us. The plans of the diligent lead to profit, surely as haste leads to poverty. It just does. That's what it leads to. Now get ready for tomorrow's show. We'll be tackling another important question. And I may have my son come on the show. We're certainly going to talk about his dog. His dog's name is Firefly, but we're going to talk about how do I budget for my pet care expenses. Now look, you might be a dog person, a cat person, or maybe you have a more exotic pet. You don't want to miss this one. We're going to be exploring how to factor in those furry or, as dare I say, scaly. I don't like snakes, but maybe you have a scaly friend in your budget. And the whole point of that is I want to do that without breaking the bank. So don't forget to tune in tomorrow. And I'm going to close with this. Remember this. My passion is to help you achieve financial success. I want to see you live out your dreams. That's what fuels me. And I want to see you do that while you grow in your faith. Because I know this. Together, we can master your finances from that Christian perspective. We can do it. You just have to make the first step and reach out to me. Well, as I always close the show, stay financially savvy, and God bless you.
Thank you for joining us on the Ask Ralph podcast. And with a simple click to subscribe, we'll invite you back to our next episode. And remember, financial issues don't have to be complicated. Just ask Ralph. The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media, Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.